Well, firstly, I want to thank you for joining us tonight. We've got a special guest I'll introduce in just a minute, but James, my good friend and business colleague, we're co-hosting this seminar. James Longstreet from Calgary, and I'm in beautiful BC and in Chilliwack. And our glorious guest, Mark Taucar, he's coming all the way from Ontario, just north of, I think it's north, you're north of Toronto, right? Where
North of Toronto. Don't hold it against me, though.
Okay, we won't. Yeah. Well, you're not in the playoffs anyway, so we're okay.
No, I'm not a Leafs
Yeah,
fan.
yeah,
No,
yeah.
I'm
Mind
a
you,
Leafs
nor are
fan.
we.
Bill.
But anyway, that's that. Only James's
We're up
team's
two now.
left. But anyway, so I want to spend just a couple of minutes. So Mark, I've actually known for well over, I don't know, 10, 12 years, well, probably 12, 13 years in my Calgary days. And Mark has actually been in the industry for about 26 years and started off with banking, and then he went into being a stockbroker, and then realized he really didn't want to flog stocks with people. So he actually, he got his chartered financial analyst designation, which allows him to build portfolios. So since 1999, Mark has actually been building portfolios and managing them. And so Mark can manage pensions. He has I think it's the highest designation in Canada for managing money. And so he's very good at what he does. He's very defensive, but I'm not going to talk too much about, because I'm going to get Mark to actually tell us really what he does. So, I'm going to pass this off to James, and we're going to kind of just get right into this. So just so you know, it'll be about 45 minutes. And then there'll be Q&A. So anyone who has questions, please feel free to write in the Q&A, and then we'll address those at the end of the seminar. So go ahead, James.
Sure. Thanks, Bill, and thanks, Mark. So, yeah, Mark, why don't we start with, can you share with us what is your current assessment of the global economy and markets, both globally and also in Canada? Let's start there.
Yeah, it's always good. That's kind of a good starting spot, just to kind of put the stick in the ground and then go from there. What I'm going to do, if it's all right, guys, I'm going to bring up a slide here just to help us kind of work through, maybe the major points in where we are in the markets and how we intend on kind of dealing with them. But give me 1 second here, and I'll start our slideshow. All right. So essentially, the four key major points I want to really touch on, and everything the past couple of years has really been driven by inflation, right? Interest rate cycles, regardless whether they're high, they're low, no matter where they are, they really kind of drive where markets go over the course of the short term, long term, and so on. It's, you think of it, the teeter totter of asset allocation. When interest rates are high, people want to move towards fixed income. When interest rates are low, it gives businesses out in the marketplace an ability to borrow those funds, reinvest back in themselves, and then start this process of growing a company, getting earnings, paying dividends. So where I think we are right now in the cycle is that interest rates are going to remain higher for longer until something breaks. And there's a higher likelihood something's going to break in Canada in the short term versus that in the United States or perhaps anywhere else. Inflation will force interest rate differentials between the US and Canada to widen. And so we may actually have some potential for dislocations when it comes to currency. And so what I mean by differentials, of course, the Bank of Canada and the United States Federal Reserve, they're going to increase and decrease interest rates, hopefully based independently on where their own markets are. But there is some concern about where interest rates go in other jurisdictions. And by virtue of the fact that, let's say, one jurisdiction remains higher than another, then of course, as an investor, you may want to position your assets more in a jurisdiction that has higher interest rates. And when you have currency leave a certain jurisdiction, that's going to cause shifts in where the foreign exchange is and currencies. So potentially a dislocation in currency in the next little while here. The central bank in Canada, as it has always done, in every central bank, and when I kind of look back in history, they've never been proactive enough and they've always been overreacting. So what's going to end up happening here in my books is they're going to have to get hit in the face with the realization that interest rates have remained too high for too long. Something's going to have to break. And then when it does happen to break, we're going to have to see interest rates come down a little bit more aggressively here in Canada than we will elsewhere. And I think that'll be a surprise to the market. The second, or the once we get into the markets here, a very, very important point. I'm referencing what's called the Shiller PE, but you can even reference just the normal price earnings of the S&P 500. The normal price earnings of the S&P 500 on average has tended to be about 17 times. Now, for those people who are watching, what price earnings means is essentially the price of the stock divided by what the earnings of that stock can give you. And if you actually break it down into time, it's how many years you have to wait until the earnings pay back what you paid for the stock initially. So when we talk about price to earnings, that would mean a price to earnings of 17 times would mean you have to wait 17 years on average for the earnings of the company or the earnings of the index or whatever you're investing in to pay you back what you initially put into it. Now, here's where we really kind of hit the rubber hits the road. Current price earnings is 35 times.
Wow.
So think about that payback. Think about that payback. Debt to GDP increases while the GDP per capita decreases. That's what we're seeing right now. In Canada, we have one of the most indebted consumers in the industrialized world. And if you actually take a look at G20 stats, we're not doing very good in terms of a household debt to GDP. So that's a concern that we should be looking at. Increasing amounts of debt, both in Canada and the United States, will lead to higher and higher refinancing rates. Yeah. So when debt rolls off the books, what's going to end up having to happen is as countries continue to deficit spend, they need to get that money from someplace. They're going to issue debts into the market. Those debts are going to have to be priced higher to reward those people who want to buy the debt. And the problem with that is, especially here in Canada and in the United States, for too long, is a greater and greater proportion of the budgetary income is going to be absorbed by just simply servicing that debt.
Yeah.
And here in Canada, we've had worsening productivity and worsening business output. So if you happen to be an entrepreneur, well, geez, you're not having a good time of it in Canada. There's a lot of bureaucracy and a lot of impediment to you building a business, a lot of impediment for you to take intellectual property that you've built and catalyze that intellectual property into wealth that you can give off to the next generation. And I'll leave you with this slide because, again, pictures are worth 1,000 words, right? Here's that Case-Shiller price to earnings. So as you can see, and we go back to the 1870s, as you can see, we're here.
Yeah.
So 1, 2, 3, 4 times in history.
Yeah.
That we've been this high.
Yeah. So that's telling us the market's way overvalued, which we all know. And there's other asset classes that would fall in the same category. Hey, let's transition to the next question, Mark. Thanks. That was a great intro, kind of giving big picture. So really, we wanted to introduce you to possibly new people, potential new clients, maybe existing clients, just they may have friends they want to refer. So Mark, what is your portfolio management style? I think that's really important. So go ahead, tell us, obviously every portfolio manager has their own model, their own style. So tell us kind of how you describe what you're trying to achieve by building your portfolios.
Yeah, definitely. So again, what I'm going to do, because pictures are so important here, if you guys don't mind, I'm going to show a slide here because it kind of brings everything together, and it'll help us to, again, it'll help us to kind of formulate what we do and how we do it. So every portfolio manager, well, especially myself, having been doing this for a very, very long time, what you really have to be able to do is take a look at the global perspective for investments.
Right.
Where are the risks? Where are the potential returns that you're going to get? So when I look at the markets and when our team of other portfolio, because I'm not the only one who pulls the levers and pushes the buttons on portfolios. When our team takes a look at the markets, the first thing that we always take a look at is where is the global economy going? Where are the geopolitical hot buttons, where are the risks in the market? And from that, what we want to do is we want to derive where are the opportunities and where are the risks. And then the next level down, every market in the world can kind of be binned into what I think of as three categories: income assets, equity assets, and alternative strategy assets.
Okay.
So the next question is once we understand what the global picture looks like for investing, well, do we want to allocate into emerging market bonds as opposed to North American bonds? Do we want to be buying European equities as opposed to Canadian equities? Do we want to be holding US currency or the Japanese yen? We have to make these asset allocation decisions based upon the key drivers in those geographical regions. The next step down is what types of alternative strategies can we use to make sure that we're not correlated. So here's the big picture when it comes to portfolios. And this is sometimes, it gives clients a little bit of consternation when they look at their portfolio. They'll look at a piece of the portfolio that's going up, and for that, they're ready to write you a Christmas card and say thank you very much. But then they look at another part of the portfolio, and it's not doing what the other parts are supposed to be doing. And everyone has this idea that all parts of your portfolio should be moving up at once. That's not the case. What we want to be able to do is build portfolios that are diversified. And yes, in the long term, we want every part of the portfolio to move upwards to the right. But in the short term, we want to have portfolios that work off of each other to minimize the level of risk that you're assuming in a portfolio. And that's why alternative strategies are very, very important. So what do we use in alternative strategies? It could be stuff like covered call writing. It could be derivatives, option securities. Many people have this preconceived notion that options and derivatives are very, very risky securities. But if you sit down with me, I actually go through examples of how option writing can actually minimize risk and increase income. We take a look at stuff like private equity, private real estate, and other forms of alternative strategies, not least of which we'll be talking about today, which is gold and commodities that need to be included in a portfolio. And the other thing here is cost minimization. So we're always looking to work with custodians, work with providers who are going to provide us with lower and lower costs. Now, if that means that we have to use an exchange traded fund as opposed to go out and buy an active allocation bond, we'll do that. But if it means that, hey, the best way to do this is to go out and buy stocks, then we're going to do that too. And lastly, every bit of the way, we customize it to the client that we're dealing with. Not everyone has the same goals. Not everyone has the same time horizons. And so therefore, we have to build portfolios that have two key aspects to them. I always use this in conversations. James and Bill, you've heard me say this many, many times over. We need to understand what the expectation for return is for a client. But then beyond that, it's what's risk. What is your capacity to assume risk? And what does that mean? What's your immediate ability to assume a hit to your portfolio without it encumbering what your end objective is? And then what is your willingness to assume risk? Because you may have the highest risk capacity in the world, but if you can't withstand the gyrations of your portfolio and you want to get out, then we haven't done our job there. So that's a very macro picture of how we develop a portfolio. But then once we do that, then what we try to do is apply it to the client who we're working with. And so we have 5 key mandates. These mandates have 3 separate asset classes that get allocated to. So depending upon whether you have a mandate for income, you would come to us, and what we would do is we would build you a mandate that would have almost 100% included in income. But you'll notice here that in every one of these mandates, we have ranges. And so what does that mean? When you come to a portfolio manager You know, and I say this a lot to folks. Sometimes I say, listen, I have to apologize for how my industry has conditioned you to think about your investments. When I started in the business, there were mutual fund manufacturers who used to use, commercial campaigns with superheroes golfing on a golf course, and the tagline used to be, what are you doing after retirement? And lo and behold, they put, the hot end performance of last year's mutual fund. Well, we all know through research, if you buy last year's mutual fund, this year your chances are you're getting a dog. The fact of the matter is, though, when you're working with a portfolio manager, we think different. And the first process to all of what we do is, how do we protect your wealth? Number one, how is it that we become the stewards and protect your wealth? And then number two, once we have that parameter in terms of the amount of risk, then how, can we squeeze as much juice out of that orange to create growth in your portfolio? And so wide ranges, you'll say, well, Mark, we're looking at the balance. There's 0 to 30%, 0 to 70% equity, and 0 to 100% income. How does that add up to 100? Point being is, if I wake up one day and we stand upon the precipice of another 2008 and another bank, over a weekend, like a Bear Stearns or a Lehman Brothers, there's rumors, I can take someone into a 100% income type of scenario and hopefully reduce the risk.
No, that's excellent, Mark. Well, hey, we want to continue to progress in the questions. So, but thank you. You did an awesome job. So I guess the one point I would just say is that Mark actively manages the portfolio for his clients. He's not calling you up and saying, hey, what do you think if I buy this stock? That never happens. He's doing it to protect your money. So James, why don't you go to the next question? This one's just a shorter one, Mark.
Yeah. Thanks, Bill. And Mark. So next question we have here. This, as Bill said, this is a little shorter. Tell us, Mark, who are your ideal clients and why?
Yeah, that's a great question. And usually, it's kind of like the proverbial kick under the table. If you guys think I'm running too long, let me know. I do have a propensity to be a little bit verbose. So my ideal client here is the clients that I tend to deal with tend to be pre-retirees and retirees. And it's not just because they're older, it's because they've seen a lot and they've experienced a lot. And, I always use the line, your biggest lesson in investments happens to be your biggest loss. And unfortunately, or fortunately, however you want to put it, people who've been around for a very, very long time have gone through periods of the markets where they've seen things go up and down, and they understand themselves a lot better. And that's why pre-retirees and retirees tend to gravitate to my type of investing. Reason being is because the average client sits across the table from me, guys, and they say, look, I have 2 rules for you. Number one, this has been 30 to 40 years of our work. This is 30 years of saving, 40 years of saving. Don't blow us up. Rule number one. And rule number 2, when it comes time to flip the switch and we want to now start taking income out of our portfolios, we do not want to lose sleep. And that's a very different mindset than someone who's just come out of university who wants to just run a pot stock portfolio, right? And those are 2 very different types of people. The funny thing is if that person who's just come out of university understood what that person who's been doing this for 30 to 40 years, who built this nest egg up, they would never buy that pot stock portfolio, and they'd be doing what we're doing for our clients from day one.
Yeah. Okay. That's awesome, Mark. So really in summary, you're really people who have built up whether it's 100,000, 200, 500,000, but they don't want to lose their money and they want to make sure it's protected to be able to draw income at some point, which is a incredibly important objective, when we get late 50s or 60s or 70s, whatever. Okay. So the next question, it's you've covered some of it. So Mark, what are the main issues you are watching? You've already in the intro, but potentially you're concerned about in the economy, and so what would be the the key things you're watching right now, that, you know, as a portfolio manager that, you know, if you want to say concern you, but it's not the end of the world, but what are some of the things you're looking at there we go. Oh,
Oh, yeah. Hold on. There we go. I've got a few things that I want to talk about when it concerns that.
okay.
So I do have some risk and opportunities.
Excellent.
The risks for anyone right now when it concerns their portfolio, um, where we see landmines in the economic in the investing space right now is commercial real estate.
Yeah.
And I think there's a massive bubble right now in commercial real estate here in Canada in particular, also in the United States. But what we're finding here in Canada is that there is less of a lag for Canadians to be affected by interest rates, okay, versus that of the United States. So many people will say, well, why aren't we seeing a slowdown in the United States like we are seeing in Canada? Primarily because Canada has a structural difference between that, a structural debt difference between that of the United States. In Canada, people have to sing for their lunch every 5 years when it comes to a mortgage and renewing mortgage. Where in the United States, you can go 30 years on a mortgage, and if interest rates go up by 3 or 4 times, it doesn't matter because you're holding something for 30 years. Canada, however, we have a shorter renewal period. And because of that, when interest rates go up and you're using debt, and especially in a commercial real estate scenario where you may not have you may not have higher vacancy rates, and so therefore costs are higher because you're spreading over fewer and fewer occupancies. We have a very large issue right now in commercial real estate in Canada, and it's predicated on debt.
Mark, also, I just wanted to interject. I just saw the stat the other day. 36% of workers are now working at home. Like, talk about putting stress on commercial real estate, all those buildings that are sitting empty, right?
Well,
Or not empty, but they've had to downsize massively.
Case in point, though, to that point, I work with 3 custodians, 2 of which are major banks. When I call up my custodian, I used to go down to the offices. They would have, the 51st floor all the way to the 58th floor. Now, if you're a manager and you're saying, well, we've got to cut costs and we want a robust bottom line, and looking around and you're only using half the space that you were before, what's the easiest thing to cut? You cut lease obligation, right? So this is going to be a bigger and growing problem with commercial real estate space. Canadian dollar depreciation, I think, is also going to be something that everyone has to manage appropriately. So what do I mean by that? I alluded to it by differentials. So when you talk about interest rate differentials, I think because the U.S. economy is stronger and because it tends to be seen as a safe haven, what you're going to find, as well, because the Canadian economy is going to run into a lot more headwind a lot sooner than the U.S. economy, you'll have Tip Macklem want to cut interest rates as quickly as possible to salvage. And because of that, you're going to have this differential that begins to grow. And when that happens, the Canadian dollar comes down. So be mindful of where you're allocating your investments. The next thing in Canada, we have a productivity gap and deficit spending and taxes. If you make 6 figures or 7 figures, you seem to be the enemy of the government. And it's because and your taxes have continued to go up, and on top of that, spending has gone on up, and we have new taxes that are being proposed in terms of capital gains taxes. And you know what? If you're an IT specialist that has intellectual property, why on earth would you want to start your company here in Canada?
Yeah.
Why would you stay here when you have no incentive to grow a company, when you're going to have to owe the government a massive amount of that wealth, where you can just up and go to friendly nations and friendly states south of the border, where they welcome that entrepreneurial spirit, capitalizing the intellectual property. And oh, by the way, if you have to make $100 million, you're going to keep the vast majority of it. So
Yeah.
we have a productivity gap here in Canada that's continued to grow. And some sectors, of course, are overpriced, not just here in Canada, but in the United States, as I alluded to, the Case-Shiller Index. A lot of that has to be technology companies. You know, AI, just like anything else, is going to become commoditized. Chips that run AI, you know, as sooner rather than later, there are going to be other companies out there going, hey, you know what? If NVIDIA is making these huge margins, well, why don't we invest a whole bunch of money to make those chips too? Where are the opportunities? Interest rate sensitive securities. You want to take a look at buying bonds, utilities, consumer staple type of investments. Why? Well, consumer staples, even if we go into a recession, people still need to go buy groceries. They still need to pay for their utility bills, their gas. Bonds, you want to buy bonds because as interest rates fall, bond prices appreciate. Think of a teeter-totter. So conceptually, interest rate sensitivity looks like a teeter-totter. On one side of the teeter-totter, you have price. On the other side of the teeter-totter, you have interest rates. And this is where any individual who has held a income type of portfolio over the past 2 years, it's kind of looked at it and it hasn't really performed, you know, in line with, let's say, the market, because interest rates have been going up. But what happens when interest rates now start coming down? Interest rates come down on the teeter-totter this way, the prices of good paying dividend stock, utility stock, bonds, preferred shares, will those prices start to rise? Next thing we need to have is global diversification. We know that there are landmines on the path of every investment journey. What you want to be able to do is put your eggs in all different types of baskets, and that includes alternative strategies. It includes private types of investments in real estate, commodities, gold, copper, and uranium. We are at such a shortage of electrical supply here in Canada.
Yeah.
And where is it going to come from? It's going to come from the ground. So we need to be able to supply those raw materials if we're hell bent for leather, to make sure that there aren't any more internal combustion engines vehicles in Canada by 2030 or 2035, whatever ridiculous year they've used. Well, then we need to be able to power a grid that's capable of being able to charge those amount of batteries. So uranium, because apparently we're not going to be able to use fossil fuels anymore to generate electricity. So it's going to have to be something along the lines of nuclear power. But then on top of that, copper, because copper will feed that electricity into the system. So those are the risks and the opportunities that I see today. The biggest thing when you're working with any portfolio manager, when you're working with us, is we need to understand the risks of your situation, what your objectives are, and how to mitigate what we think may happen in terms of a black swan event by diversifying you across various sectors. But the immediate opportunities right now is you want to take a look at good paying dividend stocks, good paying bonds, utilities, consumer staples for your portfolio.
I just saw, because I track commodities very closely, gold's up over 20% year to date. Silver up 32% year to date. Uranium up, and I've been trying to tell people, like, you should have a position in commodities, whether physical ownership or stocks or ETFs. And on a personal level, I do all of those things. I can't do that for my clients other than the physical, but the bottom line is that should be a portion of your overall portfolio. And good on you, Mark, because there's some, talk about PE ratios. You get some of the best performing mines in the world. They are cash cows right now. Same with silver mines that are dividend bearing. I mean, they are spitting out cash like insanity. And it's the market's just starting to wake up to this reality, right?
Right. And so, and that's an important part of when you're looking at the markets today and you see what the NASDAQ has done and you see what some of these high flying tech stocks have done, realize that when you go back in time and look at the long-term average of any stock exchange, a very significant chunk of that long-term return has been cash that's been returned back into the shareholders' hands.
Yeah.
So the promise of future growth, that's all great, fine and well. But when interest rates are very high, that actually reduces the bottom line of every company that relies on debt. And when deficit spending is high, governments need to tax people in order to cover the fiscal policies that they're enacting. So that's another draw on debt. You need to be able to find an income stream that's going to compensate you during these periods of time when we have headwinds for capital appreciation.
That's great. Hey, James, did you have any questions or comments to Mark? Just interject.
What I was going to say here is I believe we've covered the questions that we'd intended on covering. So what we can do is within maybe a few minutes we can open up for Q&A. So if you have any questions, just type them into the chat bar. But another question I just thought of, Mark. Why don't you share with us, Mark, how you align your interests with that of the clients you work with? In other words, your investable assets. How do you have your portfolio invested relative to your clients?
Yeah, that's a great question. In fact, actually, and you guys have seen this as well when we're online with clients, I've brought up my own account when clients have asked to see what am I going to invest in, right? As a client, they'll say, well, what am I going to invest in? And they're new prospects. We haven't brought them on board yet. There have been many times, whether it's in the first meeting or in annual reviews, I've brought up my own investments to say, this is exactly what you own. So when I started this firm, one of the key rules I had, and one of the commitments I have for all clients, is that I eat my own cooking. And it's irresponsible of any portfolio manager to look at a client and say, this is what you need to buy if they don't own it 100% themselves. And so that's why, I bring up my own screen. I let them see what I own in my own account. And then lo and behold, when we bring their accounts on and we build it out, we all own the same. And the reason is I always tell clients this: you have every right to pick up the phone, and if you feel like you need to tear a strip off me because we've made some poor decisions, so be it. Do it, but realize we all hold the same securities, and if I didn't believe in them, we wouldn't own them.
That's a great point. And well, there's just one last little part of the last question that I just thought. So, for full transparency, so like with your different portfolios that you've built and that you're managing, so what kind of returns are we for clients or prospective clients so in the different mandates, would you mind just giving just a quick on your performance and what they can expect? You're not buying NVIDIA, right? If so, you're not trying to go for 180% a year. You're that's not your game at all. So why don't you just share
So the way we look at investing, the way that we look at performance, if you wanted to maximize the performance of any portfolio, historically, you'd put 100% of your money into the stock market. Okay? But if you did that, then you'd also have to be willing to go through periods of time where in 2008, 50% of your assets would have evaporated like that in the course of 3 to 4 months.
Yeah.
So we know that a lot of people who are pre-retirees and retirees, they don't want that.
Right.
So that's our starting. And then where do we end? Well, if you cannot withstand the ups and downs of the market, then you shouldn't be talking to us and you should be buying GICs. Probably you shouldn't be buying GICs, but at the end of the day, if you can't sleep seeing your assets go down, then that's the bottom, right? So we have top and we have the bottom. The bottom is, what is the risk-free rate? So you look at a T-bill. Today, these days, you're looking at maybe 5%. The maximum rate of return you're looking at is 100% in the market, so 10%. So now when we're working with clients, now we have an ability to quantify where along that spectrum you need to be. But typically when we have an income portfolio, so let me go back and if you don't mind, guys,
just show a performance of how you've been doing if you've got it there.
So let's go Oops. It's here somewhere. I knew I had it. There we go.
There we
So
go.
what we've tried to do is what's called volatility. That's the amount of up and down in the portfolio that you can expect to have. The higher the number, the worse it is. So as an example, global volatility in the past 3 years has been close to 17%. So
Wow.
we're
Yeah.
looking at 1/3 less the volatility of the global equity markets. If you've invested in income producing assets, the past 3 years, your investments have kind of gone sideways because interest rates have been going up. So what you'll see is that, the 3-year numbers don't necessarily look all that stellar. But again, because we're so interest rate heavy, you'll start to see the reversal. We're now at the top of the interest rate cycle and we're starting to come back down again. And that's indicative of what you've seen here in the 6-month numbers.
Yeah, there you go.
So if we continue to see interest rates come back down, and again, these 6-month numbers have just been on the promise that we're not going to see any more interest rate increases. We haven't yet seen an interest rate cut. So, and I can attest to the fact that in the past 3 weeks alone, we've seen almost 5% added to the portfolio. So, so this is where we are today in terms of the portfolios. If you're an income investor, our current portfolio actually yields close to 5.3, 5.25%. That means without even taking anything out of the portfolio, just the dividends that you're going to get is 5.25%. And that's not counting what will happen when interest rates begin to fall. Those assets will begin to increase.
Yeah, and I remind people when interest rates start falling, that means there's a crisis in the economy. Like people are all like, oh, I can hardly wait till they drop interest rates. Well, that you better be careful what you're asking for, because historically when interest rates start coming down, that means there's job layoffs, there's more problems in the economy, right? And as you already mentioned, Mark, really important. If you're planning a US trip, you better do it soon, because our dollar is going to drop 60 something cents or 50, who knows, depending on how, if our central bank gets very aggressive. Whoa, like if you have any plans to go to the US, you ain't going to want to go there because it's so ridiculously expensive, right?
So, and just to add on that, when you take a look at the volatility of a bond portfolio, so short to medium term bond portfolio, you're actually looking at volatility that's even higher than what you see here. So what we're trying to do is create a portfolio that has less risk or risk in line with the bond portfolio, but then actually does better than bonds. So if you've actually held bonds over the past 3 years, you would have gotten a negative rate of return. So our risk is very much like what you'd find in the bond portfolio, but it's much less than what you would find in an equity portfolio. We're doing better than what you would do in bonds. And we're positioned right now. If you've got money to put into the market, these are the areas you want to take advantage of. Very interest rate sensitive securities.
Yeah. So how much of your portfolios on average, like or approximate, are in dividend bearing stocks? And that's really important because historically dividend bearing stocks way outperform a stock with no dividend historically.
Right. And so here, what I wanted to do is just kind of divide up what the current portfolio looks like. These change on a day-to-day basis. And so what you'll find is that today, on this side of the asset allocation spectrum, we have what's referred to as income generating securities. Then we have equity securities and alternative strategies. Let me distinguish between these. Income generating securities for myself are cash, bonds, preferred shares, and then high paying dividend producing securities. Equities are stocks, but stocks that would rather reinvest more back. And the hopes here is that you buy, let's say, a Stella Jones for $83 today, and in 10 years' time, you sell it for $160 or $200. And then
Right.
lastly, alternative strategies are different than even income and equities, because what they do is it doesn't really matter necessarily about um, where interest rates might be going per se. If you have a commodity or real estate or a covered call type of product, you may have movement that's different from both equities and so what you have here in terms of dividends, dividend rates, currently dividends anywhere between, low 3% all the way up to 8.6% in
Yeah.
income producing assets. In
Nice.
equity, very small dividends, as you can see, except for Algoma Central. We continue to hold that because they're actively going into the market, buying back their own shares. We consider that a good sign. And then lastly, when you get into the alternative strategies, we can have allocations that range up to 30%. In fact, actually, in the next little while here, we'll be probably taking most of our alternative strategies closer to a 30% weighting in everyone's portfolio. Equities will probably be in and around the 25% range, and then income it will be anywhere between 45 to 50%.
That's awesome, Mark. Hey, we're at about 40 minutes. I do see we have one question. Hey, if any in the audience have any questions with Mark, I always tell people, when's the last time you talked directly to your portfolio manager? It's very, I actually only, I think, met one person in my whole career who said I talked to my own portfolio manager. So if you have a question for Mark that hasn't been addressed, or just something you'd like to ask him, please put it in the Q&A. And so, James, any final questions for Mark, and then we'll go right into Q&A.
I thought we'd just start with the Q&A here, Bill, unless
Okay.
you have any final questions. I think thanks, Mark. That was very thorough. So the first question we have in the Q&A here, Jeff is asking, Mark, what do you think of using a covered call strategy with dividend stocks?
Absolutely love it. In fact, actually, you'll be able to see here the Brompton Split Bank Corp and then the BMO Covered Call Utility ETF. We tend to use ETFs at times only for operational efficiencies, but there are times where I've been known to go and write covered calls as well. The idea here, the beauty of covered call writing is what you're doing is you're minimizing the actual volatility of the overall portfolio, but at the same time, you're crystallizing some income at the same time. The Brompton Split Bank Corp was something we added to the portfolio back in October. And at that time, clients who were with us are collecting close to, I believe it's a 15% yield on that security, 15%. How does that happen? Well, it happens because that particular holding goes out and buys the big six banks. And what it does is, let's say the Bank of Montreal, we all hold the Bank of Montreal today. It's trading at $130. We pick a price, might be 132. We say, listen, why don't we write a bet in the market for $132? We don't think Bank of Montreal is going above 132 bucks. We'll sell that bet for $1.75 for every share that we own. In a month's time, what ends up happening, again, we collect that $1.75 for selling the bet. So Bill and I, that's what we're doing. James, on your end, you're doing your research and you're saying, you know what, Bill, Mark, I bet you Bank of Montreal is higher than 132 in a month's time. I'll take your bet. So two things happen. If Bank of Montreal pays out its dividend, Bill and I will get to keep that dividend over that period of time. At the same time, we also get to keep the proceeds of having written that bet. And in 1 month's time, if Bank of Montreal is less than that price that we specified in our bet, we get to keep Bank of Montreal. So what do the next month all over again? We pick another price. We pick 134 bucks and we do it over and over again. And so what it does is it takes a dividend stock that might be paying us, 4.8% or 5%. And because we're enhancing the income by generating our own income stream, we can take a 4.8% income stream and turn it into potentially a 15% income stream.
Nice.
So that's an excellent way of actually doing to mitigate risks of the portfolio, but not only that, but to generate more income for yourself in the portfolio. We have that with the Brompton Split Bank Corp and the BMO Utility Covered Call ETF. Again, utilities are a great stock to own right now. Why? Because their pricing very much similar to what bonds will be pricing, or how they price based on where interest rates are going. How and why does that work? Utilities use a lot of debt to fund their operations. As interest rates are high, that debt erodes the bottom line. As interest rates drop, the bottom line begins to expand again, and therefore that's what every investor wants. And so utilities go up in price. So we do own utilities in a non-covered call, but we also own them in a covered call writing scenario, just because they write fantastic income. On that particular position, you can get close to an 8% dividend income stream.
Awesome. Hey, and actually Jeff has a second question, but again, if any in the audience would like to have a question, please do it. We still have a few more minutes. We've just actually hit the 45-minute mark, and we're happy to stay on for another 5-6 minutes or 10 minutes. And so if you have questions, please write them in the chat. So this is Jeff's second question. Is it still a good time to add to gold and silver holdings?
Absolutely. So right now, if we anticipate that in the United States, they're going to continue to fund their deficits, fund their spending with deficits, then typically gold is negatively correlated with the strength of the US dollar. As more and more debt gets put onto the books of the Fed, of the U.S. government, and deficit spending increases, that's always a great time to be owning gold. And on top of that, there just really isn't a lot of supply of gold out there. Sure, Bill and James, they do a lot of research in gold, and they can confirm that. There just isn't a lot of supply of gold out there right now. And what's really interesting is a lot of central banks right now are actually starting to buy gold. So if you have very little supply, if you have demand that's starting to increase, and you have deficit spending that doesn't look like it's going to end, because we can think of, if Trump gets into power, is he not going to want to make the economy look as good as possible? And if that means he has to go spend money to do it, do you think he's not going to do that? Yeah. Because he proved in his last administration he was willing to do that. So herein lies, I think, a great time to add gold to the portfolio.
Yeah, thanks, Mark. I'm just going to add a couple comments because, as you know, I follow it very closely. So gold, the central banks have been buying the last 3 years, the largest percentage of gold ever, over 1,000 tons of gold. They're buying every month, like a lot of Eastern countries. But that's one factor. As if any of you are following what's happening in China, their real estate market has collapsed. Their stock market it's collapsed something, it was at 80-90%. So the Chinese are buying gold, and they have a 4,000-year track record of buying gold anyway. It's very much cultural. So the Chinese are buying record amounts of gold. And then on the silver front, this will be the third year in a row that silver's been in a huge deficit of like 150 million to 200 million ounces shortfall. And what's driving the demand on silver is huge growth in the solar panel industry. And with the new technology, they actually use like 30-40% more silver in each panel, because it just makes it more better electrical conductivity. And so you have that. So India and China are buying record amounts of silver. So, you put it all together, and to your point, Mark, with the insane, so, Biden's running up $1 trillion new debt every 90 days or 100 days. Every 100 days, he's running up $1 trillion more deficit. So, yeah, I would I've said this so many times over the last 10-15 years, you need to have gold and silver as part of your wealth portfolio. And the good thing is Mark, believes in that too. And has positions in his portfolio as another hedge against the risks of, I'll be gracious, but politicians who really have no clue what they're doing running our country and running these massive deficits with no regard to how that affects the average Canadian. Like the inflation has been driven by central banks and of course our governments provincially and federally running huge deficits. But anyway,
And I may
I'll
rather
I'll
really
just jump in, Bill, and piggyback and add a few other additional comments further to what you shared. First, central banks last year, Q1 of 2023, central banks had purchased. It was in Q1 of 23 was the most gold buying ever in any Q1 in history of central banks. And Q1 of 2024 was greater than 2023. So the last 2 years in Q1, central banks have purchased more gold than any Q1s in recorded history. I just saw another article today. China, it's now been 18 months in a row. They've increased their gold holdings. And silver, one other point on silver. There's no other metal on the planet that's priced below its 1980 high. Right? Silver is the only one. So yeah, we're all on certainly a similar page with when it comes to those commodities. And yeah, just wanted to throw that in there as well. So yeah, Mark, any other thoughts? Bill, any other thoughts? And do we have any other questions?
Maybe just Mark, you know what? I want to respect people's time. So any just closing thought, Mark, and then we'll end the webinar with your closing thoughts to the guests that are on and your final thoughts.
Yeah, the one thing that I'll say here is what's going to dictate the performance of a lot of portfolios out there in the next year here will be where interest rates are going. If people believe that Canada is in a strong economic position and interest rates are not coming down, then you want to steer clear of dividend types of securities. But I'll say this, that's not the case. We're starting to see really bad economic data come through. We're starting to see unemployment in the GTA, Greater Toronto area. Unemployment has already hit 8%.
Wow.
So remember that the central bank has two jobs. The first job is to control for inflation. The second job is to make sure anyone who wants a job can get a job. I can tell you that inflation is going to start to get under control really quickly here because fewer and fewer people are able to go to the pub on a Friday night and then go to a movie. So when you're spending a lot less money, that means there are fewer goods that are going to get sold. That means inventories are going up. That means sales start coming out, and we're already starting to see that trend. The next thing that's going to come in, that checkbox, we're dealt with inflation. Now, when we go into a softer economy, the central bank needs to make sure that people who want to work get to work. And the way that they do that is they start cutting interest rates. Yeah. So if you're looking at doing anything right now with investing, you want to be looking at good cash flow producing securities, good bonds, good dividend income type of securities. Take a look at your gold, your utility stocks, and your consumer staples. And within a year to 2 years' time, you'll have a fantastic portfolio that you'll be really.
Wow. Well, firstly, Mark, thank you again for your valuable time and your expertise. We really appreciate it. I didn't say that at the beginning, and I should have. Mark is actually a part owner. He's a partner in Excellent Capital. His partner is an expert on commodities, as well as he manages an exempt market dealer. And then Mark is the portfolio. He has a team that they actively manage clients' money for them. And Mark has done an excellent job. He's, managed. I think you've managed well over $1 billion of assets at times in your career. I mean, so. If you're looking for someone who is trustworthy, who has 100% alignment with yourself, has strong values, I can speak for that personally because I know Mark quite well, and is trustworthy. I would, reach out to myself or James, depending on which side of the side you're on. But if we would be happy to introduce you to Mark. and do set up a call and see if he would be a good fit for managing some or a significant portion of your wealth. So again, thank you everyone for joining us today. Thank you, James, for co-hosting, and then most importantly, I want to thank you, Mark, again for your time and just sharing your insights tonight. So have a good rest of Wednesday night, depending on what time it is. I guess Toronto, you're getting close to 10 o'clock. Where
On 10 o'clock.
yeah, I'm only 7 o'clock. So anyway, well, and James is, I guess, 8 o'clock. So anyway, have a great rest of the evening, and thank you for joining us tonight, all the guests. Okay, good night.
Thank you.
Night.